Section 4.1 to 4.3 Capital Gains, Behavioral Considerations and Emotional Management. 4.1 Investor Behavior and Capital Gains. There are several common behavioral biases that can impact investment decisions. These biases can cause investors to deviate from rational and objective decision-making. Here are some of the most common biases. Confirmation bias. This bias involves seeking out information that confirms pre-existing beliefs or opinions and disregarding information that contradicts them. Investors may selectively interpret or remember information that supports their investment decisions, leading to a skewed view of the potential risks and rewards. Overconfidence bias. Overconfidence bias refers to the tendency for individuals to overestimate their own abilities and the accuracy of their predictions. Investors may have an inflated sense of their ability to pick winning investments or time the market, which can lead to excessive risk-taking and poor investment outcomes. Loss aversion. Loss aversion bias occurs when individuals feel the pain of losses more strongly than the pleasure of gains. Investors may become overly cautious or reluctant to sell losing investments, hoping for a rebound to avoid realizing the loss. This can lead to holding on to underperforming investments for too long, potentially missing out on better opportunities. Herd mentality. Herd mentality bias is the tendency to follow the actions and decisions of the crowd. Investors may feel more comfortable making investment decisions that align with popular trends or the consensus opinion, even if the underlying rationale may be weak. This can result in a lack of independent thinking and herd-driven market bubbles or crashes. Anchoring bias. Anchoring bias occurs when individuals rely too heavily on initial information or reference points when making decisions. Investors may fixate on a specific price at which they initially purchased an investment and base future decisions on that anchor, rather than objectively assessing the current market conditions and fundamentals. Recency bias. Recency bias is the tendency to give more weight to recent events or information when making decisions. Investors may be overly influenced by recent market performance and extrapolate short-term trends into the future, leading to buying or selling decisions based on temporary market fluctuations rather than long-term fundamentals. Availability bias. Availability bias refers to the tendency to rely on readily available information or vivid examples when making decisions. Investors may overweight the importance of recent news or events that are more memorable or easily accessible, potentially overlooking broader market trends or longer-term data. It's important for investors to be aware of these biases and take steps to mitigate their impact on investment decisions. This can include seeking diverse perspectives, conducting thorough research, maintaining a long-term investment strategy, and regularly reviewing and reassessing investment decisions based on objective criteria rather than emotional reactions. Working with a financial advisor can also provide an objective perspective and help counteract behavioral biases in the investment decision-making process. Managing emotions, such as fear and greed, is crucial for making sound investment decisions. Emotions can lead to impulsive actions that may be detrimental to your long-term investment strategy. Here are some strategies to help manage emotions and avoid making irrational investment decisions. Set clear investment goals. Define your investment goals and establish a clear plan. Having a well-defined investment strategy based on your financial objectives can help anchor your decisions and reduce the influence of short-term emotions. Maintain a long-term perspective. Take a long-term view of your investments. Remember that short-term market fluctuations are common and should not dictate your investment decisions. Keep focused on your long-term goals and the overall performance of your portfolio rather than getting caught up in day-to-day market movements. Conduct thorough research. Make informed investment decisions based on thorough research and analysis. Avoid making impulsive decisions driven by emotions or speculative information. Take the time to understand the fundamentals of the investments you're considering and assess their long-term potential. Stick to your investment plan. Develop a well-diversified investment plan that aligns with your risk tolerance and long-term goals. Once you have a plan in place, stick to it, regardless of short-term market fluctuations. Avoid making drastic changes or frequent trading based on emotional reactions to market movements. Regularly review your portfolio. Schedule periodic reviews of your portfolio to ensure it remains aligned with your investment strategy. By regularly assessing your investments, you can make informed decisions based on changes in your financial situation or market conditions rather than emotional impulses. Practice risk management. Implement risk management strategies to protect your portfolio and manage downside risk. This can include diversifying your investments, setting stop-loss orders to limit losses, or using trailing stops to protect profits. Having risk management measures in place can help alleviate some of the fear and greed that may arise during market fluctuations. Seek professional guidance. Consider working with a financial advisor who can provide objective advice and guidance. A professional advisor can help you navigate market volatility, keep emotions in check, and make rational investment decisions based on your long-term goals. Control the narrative. Be mindful of the information and media you consume regarding your investments. Limit exposure to sensationalized news headlines or speculative opinions that may trigger emotional responses. Focus on reliable sources of information and maintain a balanced perspective. Practice patience and discipline. Investing requires patience and discipline. Avoid making impulsive decisions based on short-term emotions. Stick to your investment plan and have confidence in your long-term strategy. Remind yourself of your investment goals and the rationale behind your decisions during periods of market volatility. By employing these strategies, you can better manage emotions such as fear and greed and make more rational and informed investment decisions. Remember that investing is a long-term journey, and managing emotions is a critical component of achieving your financial goals. Maintaining a long-term perspective and staying invested during market fluctuations is crucial for achieving investment success. Here are some reasons why a long-term perspective and staying invested are important. Capitalizing on compound returns. Investing is a long-term endeavor, and the power of compound returns becomes more evident over time. By staying invested, you give your investments the opportunity to grow and compound over the long term. The longer your investment horizon, the greater the potential for your investments to generate significant returns. Smoothing out market volatility. Markets are inherently volatile, and short-term fluctuations are a natural part of the investing landscape. Trying to time the market and make investment decisions based on short-term movements is challenging and often counterproductive. By maintaining a long-term perspective, you can smooth out the impact of market volatility on your portfolio and focus on the overall trend of growth over time. Overcoming short-term noise. Short-term market movements and news events can create noise and distractions that may tempt investors to make impulsive decisions. Staying invested with a long-term perspective allows you to filter out this noise and focus on the underlying fundamentals of your investments. It helps you avoid knee-jerk reactions to short-term events and stay committed to your investment strategy. Taking advantage of dollar-cost averaging. Staying invested over the long term enables you to take advantage of dollar-cost averaging. By consistently investing a fixed amount of money at regular intervals, you buy more shares when prices are low and fewer shares when prices are high. This strategy can help smooth out the impact of market fluctuations and potentially enhance your overall investment returns, allowing time for market recoveries. Market downturns are a normal part of the investing cycle, but they are typically followed by periods of recovery and growth. By staying invested during market downturns, you give your investments time to recover and participate in the subsequent market upswings. Timing the market by trying to exit before a downturn and re-enter before an upswing is extremely difficult and often leads to missed opportunities. Avoiding emotional decision-making. Emotional decision-making can be detrimental to investment performance. Short-term market movements can trigger fear or greed, leading to impulsive buying or selling decisions that may not align with your long-term goals. By maintaining a long-term perspective, you can minimize emotional decision-making and make more rational and disciplined investment choices. Achieving long-term financial goals. Many financial goals, such as retirement planning, education funding, or wealth accumulation, require a long-term investment approach. Staying invested over the long term increases the probability of achieving these goals by allowing your investments to grow and compound over time. While staying invested during market fluctuations is important, it's equally crucial to regularly review and rebalance your portfolio to ensure it remains aligned with your long-term goals and risk tolerance. Periodic assessments can help you make adjustments based on changes in your financial situation or market conditions while still maintaining a long-term perspective. Remember, investing should be approached with a focus on the long term, and short-term market fluctuations should not drive your investment decisions. By maintaining a long-term perspective and staying invested, you increase your potential for achieving your financial objectives and maximizing your investment returns. 4.2 Monitoring and reviewing capital gains. establishing a systematic approach to monitoring investment performance is essential for evaluating the effectiveness of your investment strategy and making informed decisions. Here are some steps you can take to create a systematic approach. Set clear performance goals. Define specific performance goals that align with your investment objectives. These goals could be based on target returns, benchmarks, or specific milestones you want to achieve. Clear goals provide a benchmark for evaluating your investment performance. Determine key performance metrics. Identify the key performance metrics that are relevant to your investment strategy and goals. Common metrics include overall portfolio return, return on individual investments, risk-adjusted return, and comparison against relevant benchmarks. Choose metrics that provide meaningful insights into the performance of your investments. Establish a regular monitoring schedule. Set a regular schedule for monitoring your investment performance. The frequency of monitoring will depend on your investment strategy and the level of activity in your portfolio. It could range from monthly, quarterly, or annually. Consistency is key to capturing meaningful data over time. Use technology and tools. Leverage technology and investment tracking tools to simplify the monitoring process. Many online platforms and software tools provide portfolio tracking and performance analysis features. These tools can help automate data collection, generate performance reports, and provide visual representations of your investment performance. Track investment contributions and withdrawals. Monitor the timing and amounts of your investment contributions and withdrawals. This allows you to assess the impact of your cash flows on investment performance and evaluate the effectiveness of your timing decisions. Review portfolio diversification. Regularly review the diversification of your portfolio across different asset classes, sectors, and geographic regions. Assess whether your portfolio is adequately diversified to manage risk and take advantage of investment opportunities. Conduct periodic portfolio rebalancing. Assess the allocation of your investments and consider rebalancing your portfolio periodically. Rebalancing involves adjusting the allocation of assets to maintain your desired risk-return profile. It ensures that your portfolio remains aligned with your investment strategy and goals. Analyze performance drivers. Analyze the drivers of your investment performance. Evaluate the performance of individual investments or asset classes and assess the impact of different market conditions or economic factors. This analysis helps you understand which investments contribute most significantly to your overall performance. Seek professional advice. Consider working with a financial advisor who can provide expertise and guidance in monitoring and evaluating your investment performance. An advisor can help you interpret performance data, assess your progress towards goals, and make informed decisions based on your individual circumstances. Document and learn from mistakes. Keep a record of your investment decisions and performance results. Documenting your mistakes and lessons learned can help you refine your investment approach over time. Learn from your experiences and use them to improve your future investment decisions. By implementing a systematic approach to monitoring investment performance, you can gain valuable insights into the effectiveness of your investment strategy, identify areas for improvement, and make informed decisions to enhance your overall investment performance. Regular monitoring allows you to stay engaged with your investments and maintain control over your financial future. Periodic reviews of investment holdings are important for assessing the potential for capital gains and ensuring that your investments remain aligned with your goals. Here are some steps you can take to conduct a thorough review. Evaluate investment performance. Start by reviewing the performance of each investment in your portfolio. Compare the returns achieved against relevant benchmarks or target goals. Assess whether the investments have generated capital gains or if they are underperforming. Identify the reasons behind the performance and consider whether any adjustments are necessary. Assess market conditions. Consider the current market conditions and how they may impact your investments. Analyze economic trends, industry outlooks, and any relevant factors that could affect the potential for capital gains. This assessment will help you determine if adjustments need to be made to your portfolio to take advantage of emerging opportunities or mitigate potential risks. Review investment thesis. Revisit the original investment thesis or rationale for each holding. Assess whether the fundamental reasons for holding the investment still hold true. Consider any changes in the company's financials, industry dynamics, or external factors that may affect the investment's potential for capital gains. Consider tax implications. factor in the potential tax implications of selling an investment that has generated capital gains. Evaluate whether the tax consequences outweigh the benefits of selling the investment. If you have investments with unrealized losses, consider whether tax loss harvesting strategies may be appropriate to offset capital gains and minimize your tax liability. Rebalance your portfolio. Assess the overall asset allocation of your portfolio and determine whether rebalancing is necessary. If certain investments have performed exceptionally well and now represent a larger portion of your portfolio, consider trimming those positions to restore your desired asset allocation. Rebalancing ensures that your portfolio remains diversified and aligned with your risk tolerance. Explore new opportunities, identify new investment opportunities that have the potential for capital gains. Conduct thorough research and due diligence on potential investments to assess their risk-return profile. Evaluate how these new opportunities may complement or enhance your existing portfolio. Seek professional advice. Consider consulting with a financial advisor or investment professional to gain additional insights and expertise. An advisor can provide an objective perspective, help analyze your portfolio, and offer recommendations based on your investment goals and risk tolerance. Document and track changes. Keep records of your portfolio reviews, adjustments made, and the rationale behind your decisions. Documenting these changes helps you track the evolution of your portfolio and evaluate the effectiveness of your investment decisions over time. Remember, periodic reviews of your investment holdings are not about making frequent changes for the sake of it, but rather ensuring that your investments are aligned with your goals and taking advantage of potential capital gains opportunities. Regular assessments allow you to make informed decisions and adjust your portfolio as needed to optimize your investment performance. Making informed decisions about when to realize capital gains and rebalance your portfolio requires careful consideration of your investment goals, risk tolerance, and market conditions. Here are some factors to consider when making these decisions. Investment objectives. Start by revisiting your investment objectives and time horizon. Are you investing for long-term growth, income generation, or a specific financial goal? Understanding your objectives will help guide your decision-making process. Risk tolerance. Assess your risk tolerance and comfort level with market volatility. Capital gains realization and portfolio rebalancing may involve taking on additional risk or adjusting your asset allocation. Ensure that any changes align with your risk tolerance and long-term financial goals. Market valuations. Evaluate the current market valuations of your investments. If certain holdings have experienced significant price appreciation and are now overvalued, it may be prudent to consider realizing capital gains and rebalancing your portfolio to maintain your desired asset allocation. Diversification. Regularly review the diversification of your portfolio. Ensure that you have a well-diversified mix of asset classes, sectors, and geographies. Rebalancing can help ensure that your portfolio remains diversified and reduce the concentration risk associated with holding too much of one investment. Tax considerations. Evaluate the tax implications of realizing capital gains. Short-term capital gains are typically subject to higher tax rates than long-term capital gains. Consider consulting with a tax advisor to assess the potential tax impact and optimize your tax efficiency. Market outlook. Stay informed about market trends and economic indicators. Assess the overall market conditions and the outlook for different sectors and asset classes. Consider adjusting your portfolio based on your analysis of market trends and opportunities for potential capital gains. Regular monitoring. Establish a regular schedule for monitoring your portfolio and conducting reviews. This could be monthly, quarterly, or annually, depending on your investment strategy and the level of activity in your portfolio. Regular monitoring allows you to make timely adjustments and take advantage of potential capital gains opportunities. Professional guidance. Consider seeking advice from a financial advisor or investment professional. They can provide valuable insights and help you make informed decisions based on their expertise and market knowledge. Document and track changes. Keep a record of your investment decisions, including the timing of capital gains realization and portfolio rebalancing. This documentation allows you to track the performance of your decisions and evaluate the effectiveness of your strategies over time. Remember that making informed decisions about realizing capital gains and rebalancing your portfolio is a continuous process. It requires a combination of analysis, research, and consideration of your individual circumstances. Regularly reassess your investment goals, risk tolerance, and market conditions to ensure that your decisions align with your long-term objectives. 4.3 Professional guidance and financial planning. Making informed decisions about when to realize capital gains and rebalance your portfolio requires careful consideration of your investment goals, risk tolerance, and market conditions. Here are some factors to consider when making these decisions. Investment objectives. Start by revisiting your investment objectives and time horizon. Are you investing for long-term growth, income generation, or a specific financial goal? Understanding your objectives will help guide your decision-making process. Risk tolerance. Assess your risk tolerance and comfort level with market volatility. Capital gains realization and portfolio rebalancing may involve taking on additional risk or adjusting your asset allocation. Ensure that any changes align with your risk tolerance and long-term financial goals. Market valuations. Evaluate the current market valuations of your investments. If certain holdings have experienced significant price appreciation and are now overvalued, it may be prudent to consider realizing capital gains and rebalancing your portfolio to maintain your desired asset allocation. Diversification. Regularly review the diversification of your portfolio. Ensure that you have a well-diversified mix of asset classes, sectors, and geographies. Rebalancing can help ensure that your portfolio remains diversified and reduce the concentration risk associated with holding too much of one investment. Tax considerations. Evaluate the tax implications of realizing capital gains. Short-term capital gains are typically subject to higher tax rates than long-term capital gains. Consider consulting with a tax advisor to assess the potential tax impact and optimize your tax efficiency. Market outlook. Stay informed about market trends and economic indicators. Assess the overall market conditions and the outlook for different sectors and asset classes. Consider adjusting your portfolio based on your analysis of market trends and opportunities for potential capital gains. Regular monitoring. Establish a regular schedule for monitoring your portfolio and conducting reviews. This could be monthly, quarterly, or annually, depending on your investment strategy and the level of activity in your portfolio. Regular monitoring allows you to make timely adjustments and take advantage of potential capital gains opportunities. Professional guidance. Consider seeking advice from a financial advisor or investment professional. They can provide valuable insights and help you make informed decisions based on their expertise and market knowledge. Document and track changes. Keep a record of your investment decisions, including the timing of capital gains realization and portfolio rebalancing. This documentation allows you to track the performance of your decisions and evaluate the effectiveness of your strategies over time. Remember that making informed decisions about realizing capital gains and rebalancing your portfolio is a continuous process. It requires a combination of analysis, research, and consideration of your individual circumstances. Regularly reassess your investment goals, risk tolerance, and market conditions to ensure that your decisions align with your long-term objectives. Financial advisors can play a crucial role in capital gains optimization by providing expertise, guidance, and strategies tailored to individual investors' needs. Here are some ways financial advisors can assist in optimizing capital gains. Tax-efficient investing. Financial advisors can help investors implement tax-efficient investment strategies to minimize capital gains tax liabilities. They can recommend investment vehicles, such as tax-managed funds or tax-efficient ETFs, that aim to minimize taxable distributions and provide strategies for tax loss harvesting to offset capital gains with capital losses. Asset location. Advisors can help investors determine the most tax-efficient location for their investments across different types of accounts, such as taxable brokerage accounts, IRAs, or 401(k)s. By strategically placing investments in the most appropriate account types, advisors can help minimize the tax impact of capital gains and optimize overall tax efficiency. Capital gains planning. Financial advisors can assist in developing a comprehensive capital gains planning strategy. They can help investors evaluate the potential tax consequences of realizing capital gains and make informed decisions about when to sell investments based on the investor's specific tax situation and goals. Advisors can provide insights into tax brackets, holding periods, and available tax deductions or credits. Portfolio rebalancing. advisors can guide investors on when and how to rebalance their portfolios to maintain their desired asset allocation while considering the tax implications of such transactions. They can provide recommendations on which investments to sell or buy to optimize capital gains tax exposure during the rebalancing process. Estate planning. Financial advisors can help investors develop estate planning strategies that consider the impact of capital gains taxes. They can assist in structuring inheritances, gifting strategies, or charitable contributions in a tax-efficient manner to minimize potential capital gains tax liabilities for beneficiaries. Investment monitoring and review. Advisors can monitor and review investment portfolios regularly to assess capital gains positions and potential tax implications. They can provide ongoing analysis and make recommendations on capital gains realization, timing, and rebalancing opportunities to optimize tax efficiency while staying aligned with the investor's overall financial goals. Education and guidance. Financial advisors can educate investors about the tax implications of different investment decisions and guide them in making informed choices. They can help investors understand the nuances of tax laws, including changes in tax rates or regulations, and provide strategies to adapt to evolving tax landscapes. It's important to note that while financial advisors can provide valuable insights and expertise in capital gains optimization, investors should also actively participate in the decision-making process. Effective communication with the advisor, sharing relevant tax information, and regularly reviewing the investment strategy are essential for a successful partnership. Overall, financial advisors can offer personalized guidance and implement strategies to optimize capital gains, taking into account an investor's unique financial circumstances and goals. Their expertise in tax-efficient investing and comprehensive financial planning can help investors navigate the complexities of capital gains optimization and enhance their overall investment performance. Seeking expert advice for tax planning, investment selection, and long-term financial goals is a wise decision that can greatly benefit your financial well-being. Here are some reasons why seeking expert advice is important. Knowledge and expertise. Financial advisors and tax professionals have specialized knowledge and expertise in their respective fields. They stay up to date with changing tax laws, investment trends, and financial strategies. Their expertise allows them to provide valuable insights and guidance tailored to your specific needs and goals. Objectivity and unbiased advice. Financial advisors and tax professionals provide objective advice that is not influenced by personal emotions or biases. They can offer an impartial perspective on your financial situation, helping you make informed decisions that align with your long-term goals. Comprehensive financial planning. Experts can help you develop a comprehensive financial plan that considers your short-term and long-term financial goals, tax obligations, risk tolerance, and investment preferences. They take a holistic approach to financial planning and can assist in creating a roadmap for your financial journey. Tax efficiency and optimization. Tax planning is a critical aspect of financial management. Experts can help you navigate complex tax laws and identify strategies to minimize your tax liabilities. They can advise on tax-efficient investment options, retirement planning, and estate planning to optimize your tax situation. Investment selection and risk management. Financial advisors can assess your risk tolerance, time horizon, and investment goals to recommend suitable investment options. They can help you build a diversified portfolio aligned with your risk profile and provide ongoing monitoring and management to adjust investments as needed. Long-term financial goals. Experts can assist in defining and prioritizing your long-term financial goals, such as retirement planning, education funding, or wealth preservation. They can help you create a roadmap to achieve these goals, track your progress, and make necessary adjustments along the way. Financial education. Working with experts provides an opportunity for you to enhance your financial knowledge. They can educate you on financial concepts, investment strategies, and tax planning techniques, empowering you to make more informed decisions and take an active role in managing your finances. Peace of mind. Seeking expert advice provides peace of mind, knowing that your financial matters are being handled by professionals with the knowledge and experience to guide you effectively. It can relieve the stress of managing complex financial decisions on your own and give you confidence in your financial future. When seeking expert advice, consider working with certified financial planners, CFPs, enrolled agents, EAs, certified public accountants, CPAs, or other professionals who have relevant qualifications and credentials. It's important to choose professionals who are reputable, trustworthy, and aligned with your values and goals. Remember to actively engage with the experts, ask questions, and provide them with accurate and complete information about your financial situation. This collaboration will enable them to provide the best possible advice and help you make informed decisions to achieve your long-term financial goals.